Let's take one comprehensive problem on final account system. Y Limited, with its head office in Delhi, invoiced goods to its branch at Patna at 20% less than the catalog price, which is cost plus 50%, with instruction that cash sales were to be made at invoice price and credit sales at catalog price less discount at 15% on prompt payment. That is, if credit customers are going to make payment promptly, they'll get 15% discount. From the following particulars, prepare branch trading and P&L account for the year ended 31st March 2013 in HO books so as to show the actual profit and loss for the branch for the year. You have opening stock at invoice price, then you have debtors, opening stock 10,000, you have goods received from head office at invoice price, okay. Then you have cash sales, credit sales, cash received from debtors, discount allowed to debtors, then some expenses, remittance to head office, closing debtors, closing cash in hand, closing stock at invoice price. It was further reported that a part of stock at the branch was lost by fire, which is not covered by insurance during the year, whose value is to be ascertained and provisions should be made for discount to be allowed to debtors as on 31/3/2013 on the basis of year's trend of prompt repayment. Okay, so we have to cover some more additional items like what is the value of goods lost in fire. Then we should also find out what should be the provision that have to be made for debtors, anticipating some customers will make prompt payment, some credit customers. Okay, so if you want to proceed further, you should know what is the profit that is loaded on goods sent to branch in their opening stock and their closing stock. And for that, the clue you have is HO sends goods to its branch at 20% less than the catalog price, whereas catalog price is cost plus 50%. So if you assume 100 rupees as cost, then 50% margin, so that will give you catalog price as 100 plus 50, 150. From that you have to subtract 20% and that will give you the invoice price. Okay, so we'll have a small working note where we'll try to find out what is the catalog price and invoice price. So catalog price, if you want to understand catalog price, you have to assume cost price. Let's assume cost price is 100. So on this 100 you have to add 50%, so you get catalog price as 150. Now from that you have to subtract 20% because invoice price is catalog price minus 20%, that is 150 minus 20% works out to 30, so you get invoice price as 120. So if you want to know what is the profit, you know cost is 100, invoice price is 120. If items are at invoice price, divide them by 120, multiply them by 100, you will know what is the cost. Okay, let's get back. We'll get started. First, opening stock. Opening stock, that is on 1st April 2012, it is 12,000. This is basically at invoice price, that is it is equivalent to 120. So this 12,000 divided by 120 multiplied by 100 will give you the value of opening stock at cost. So what we'll do, we'll open branch trading and P&L account in the books of head office. Branch trading and P&L account for the year ended 31st March 2013. Debits, credits, have particulars amount. The first item will have opening stock. The first item is opening stock. As I told you, you have to take 12,000 divided by 120 multiplied by 100 and the value is 10,000. Okay, so in this way we have factored opening stock. Let's go back. Next we have debtors. Debtors will not find place in your trading or P&L account. Then you have goods received from head office, that is goods sent to branch basically, 1,32,000, and this is equivalent to 120. So divided by 120, multiply with 100 to know what is the cost of goods. So 1,32,000 divided by 120 multiplied by 100 will give you goods sent to branch. So to goods sent to branch, 1,32,000 by 120 multiplied by 100, the value is 1,10,000. Okay, go back. Then you have cash sales and credit sales. Cash sales and credit sales, it is 46,000 and 1 lakh. We'll take it to the credit of trading. Buy sales, we have cash 46,000, we have credit 1 lakh. So put together 1,46,000. Then we have cash received from debtors 85,635. We'll use this information for some other analysis. Discount allowed to debtors. Okay, discount allowed to debtors is basically an expense that will find place in P&L, but before moving to P&L, let's try to cover items related to trading. Then you have expenses 6,000 related to P&L, remittance to HO, it is not going to figure in your trading or P&L account. Then you have debtors closing balance that will help you for some other reason. Cash in hand is not going to figure in your trading or P&L. You have stock. Stock on 31st March 2013 at invoice price 15,000. So this is equivalent to 120. What is 100? That's what we have to find. So we'll say closing stock. What is the value? We had the value as 15,000. So 15,000 divided by 120 multiplied by 100. The value is 12,500. For a reason, I'm keeping it in the inner column because we have to deal with the stock that is lost in fire. Okay. So let's go back to the question. It was further reported that a part of stock at the branch was lost by fire, not covered by insurance during the year, whose value is to be ascertained. Okay, so how we are going to ascertain the value of stock that is lost in the fire? For that, we need a working note. So we'll have this working note to know what is the stock that is destroyed by fire. Okay, now we'll have all items at invoice price in this working note. To facilitate easy calculation, we'll have them in an invoice, then eventually we'll translate that into cost. Okay, now how do you know what is the stock you have lost in fire? If you know what is your opening stock, and if you know what is the goods that was received by branch, and if you know what is the goods that have been sold, the balance is supposed to be closing stock, and if it is not tallying with the closing stock you have, the difference is nothing but the goods that are lost by fire. Okay, so item number 1, we know what is our opening stock. What is our opening stock at invoice price? At invoice price, the opening stock is 12,000. So we'll write opening stock at invoice price is 12,000. Then we'll add the goods that was received by the branch from head office. That is, to goods sent to branch at invoice price, it is 1,32,000. So we'll write goods sent to branch or goods received from head office 1,32,000. So now branch should be having goods worth 12,000 plus 1,32,000, that is 1,44,000. Now from this, some goods have been sold on cash basis, some has been sold on credit basis. Okay, now when they sell on cash basis, they sell at what price? They basically sell at invoice price. But when they sell on credit, they sell at catalog price. Okay, now let's go back. What is the cash sales? Cash sales was 46,000. This is basically at invoice price, that is equivalent to 120. So we don't have any issue. We'll just capture less cash sales 46,000. It is equivalent to 120. Then we have credit sales. The question says credit sales are made at catalog price, and catalog price are 100 plus 50 is equal to 150. It means this credit sales of 1 lakh is equivalent to 150, but we said we'll capture everything at invoice price. So less credit sales, invoice value of goods sold on credit, that is 1 lakh is equivalent to 150. So we are dividing it by 150, then multiply with 120. Multiply it with 120 to know what is the invoice value of goods that are sold on credit, and the result is 80,000. So we'll take it in the inner column. So now we have invoice value of goods sold on cash as well as on credit, right? So 1,44,000, 1,44,000 minus 46,000 minus 80,000. So what is this total? This total should work out to 1,26,000. It should work out to 1,26,000. Now from this 1,44,000, if you subtract this 1,26,000, ideally you should get 18,000. Okay, so that should be the closing stock. But when you check the closing stock, we know closing stock at invoice price, it is 15,000. So if you check the closing stock, it is only 15,000. So ideally you should have how much? 18,000. But what you are having now is only 15,000. So it means there is a difference, and that difference is 3,000, and that 3,000 is the value of stock that is lost on fire. Okay, so now we have to recognize that this stock has been lost in fire. Okay, and this is basically at invoice price now. When we take this value, what are the effect? I mean, this will be affected at 2 points. Number one, this should be credited to trading account. Number one, this should be credited to trading account. And number two, this loss have to be recognized. That is, it should be debited to P&L account. And the critical point is this should be recognized at cost. What you have now is selling price. How you are going to recognize this at cost? 3,000 is equivalent to 120. So what is 100? That will give you the cost value. So it is basically 3,000 into 100 divided by 120 and you will get the value as 2,500. Okay, so we'll go back and we'll recognize that in closing stock we have to add stock destroyed by fire. The cost value is 2,500. Then we'll go to P&L also. There we'll say to stock destroyed by fire, 3,000 minus 500, that is 2,500. So in that way we have factored the effect of stock that was destroyed by fire. Okay, now let's close the trading account. Let's try to find out what is the profit and all. In trading account, I think we have captured all the items. So on credit, you have two items. If you total, it works out to 1,61,000. On debit, you have two items. The difference works out to 41,000, and we call this as gross profit. Okay. Now this gross profit have to be transferred to P&L. So we will say by gross profit 41,000. Now from this, you have to start absorbing all the expenses. So what are the expenses you have? You have expense number one, discount allowed to debtors 13,365. So we'll write to discount allowed to debtors 13,365. Then we have expenses 6,000. So we'll write branch expenses 6,000. Then stock destroyed by fire already we have factored. Then do we have any other straight expenses? No. But question wants you to find out what should be the provision. Provision should be made for discount to be allowed to debtors. Now how you are going to find this? Okay, for that we need a working note. We should understand what is the trend, because question says go by trend. Now if you want to understand that, you should know what is your total debtors. What is your opening balance? Opening balance is 10,000. What is the credit sales you have made? The credit sales made is 1 lakh. So 1 lakh plus 10,000, your total credit sales is 1 lakh 10,000. But you have given discount how much? You have given discount of 13,365, and that discount is basically 15% for prompt payment. So you have given a discount of 13,365, and this 13,365 represents 15%. So if you calculate its 100%, you will know who are those, or what is the value of debtors who have been prompt in payment. Okay, and at the same time you also know what is the cash received from debtors. You also know what is the cash received from debtors. What is the value? It works out to something like 85,635. So this is the value of cash received from debtors, and if you find out what is the 100% equivalent, you will know who are those customers who have been prompt in payment. And if you compare these two, you will understand what is the trend of the customers who are likely to make prompt payment. Okay, so for that we'll have a working note 3. We'll have working note 3 basically to find out provision for discount on debtors. So prompt payment by debtors is 89,100, and how that was calculated, that is nothing but 13,365, which represents only 15%. What is the 100%? And that is 89,100, and that's what we discussed here. That is, what is the value of this? And it works out to 89,100. Okay, the value of this is 89,100, result of cross multiplication. And you know that 85,635 is the cash you have received, and 89,100 was the prompt payment. But I think these two, more than comparing these two, what you should do, you should compare this 89,100 with total credit sales. What is the total credit sales position you have? The opening debtors of 10,000 plus credit sales during the year, which is 1 lakh, right? So it is 1 lakh 10,000. So it makes more sense when you compare this 89,100 with 1 lakh 10,000, and that tells you that 89.1% of their customers are going to make prompt payment. Okay, so that will indicate here. So prompt payment by debtors 89,100, we have an idea how we got this number. So out of 1 lakh 10,000, the portion of prompt payment is 89,100 on 1 lakh 10,000. It works out to 81%. Okay. Now we can apply this trend of 81% on the closing debtors. What is the closing debtors we have? The information in the question says the closing debtors is going to be 11,000. So we can expect that 81% of closing debtors, that is on 11,000, 81%, okay, will make prompt payment. So if I calculate what is the value, it is going to be 11,000 multiplied by 81%, and I'm going to get 8,910. So 8,910 worth of customers are going to make prompt payment, and it does not mean I'm going to give everything as discount, because on this the discount will be 15%. On 8910 I have to provide discount at 15%, and it works out to 1,337. So this is what I'm anticipating as provision for discount on debtors, and this should be debited to P&L account. So let's go to P&L. We'll capture that. To provision for discount on debtors, it is 1,337. So we have captured all the items. So now let's total the higher side. Credit side, it is 41,000. Debit side, we had 4 items. So 41,000 minus these 4 items will throw a difference, and the difference is 17,798, and this is nothing but the profit that will get transferred to general P&L account. That is basically the net profit transferred to general P&L account.